we're likely going to get another strong jobs report. Does that put March, if not already, firmly on the table for the Fed for the first one?
I think March is still very much on the table. Obviously, the question of Yellen transitioning to the new Fed chair, that would be a question. But the reality is, I'm still expecting a very smooth transition. So the data, the economy will still be leading the way rather than the personnel at the top of the Fed. And as you rightly said, these numbers are still very supportive to another hike in March. And at the same time, I think market has been very forgiving to any of the downside risks or any downside shocks to data. We had hurricanes and floods earlier last year. I think the winter this year could again be seen as a one-off where activity is only delayed and not eliminated. It's going to come back later in springtime. So I would argue that the market at this point in time are still very much in a constructive mode when it comes to looking at the U.S. economy and the global economy.
Now, you flagged inflation, and a lot of other guys have actually flagged it as well as the biggest risk, in case it does, of course, come to fruition. I mean, you look at oil, for example, you look at broader commodities and how, the sharp recent leg up. Are you starting to look more for early signs of inflation? And when do all of these things start to show up in the numbers?
I think it's very important to recognize a couple of things about the oil price and inflation and the relationship. First of all, the oil price right now, I think, is driven by a strong global growth. There's no doubt about that. And at the same time, weather effects, Iran, political tension, there are some one-offs that are driving oil price. To me, the key here is two things. One is OPEC going to start relaxing its output cuts, start to boost output a little bit more as oil price pick up? And how will shale oil producers in the U.S. react? I mean, the two schools of thought. One is that oil price picks up, they drill more rigs, or they're focusing more on profitability now rather than volume. On inflation, for central banks, especially in the developed world, I think high oil prices is probably not going to be a trigger for more aggressive monetary action because supply-side inflation is typically seen as bad inflation, where higher rates is not going to do all that much to push that inflation down. It's the demands that they care about, and that's why the Fed looks at core PCE rather than headline inflation.